Hi, everyone, and welcome to the Simplify Your Financial Life podcast. I'm Adam Lawrence, and today we're joined by a very special guest, Bob Passmore. Bob Passmore is Department Vice President of Personal Lines in the Policy, Research, and International Department of the American Property Casualty Insurance Association, or the APCIA. Representing nearly 60% of the U.S. property casualty insurance market, APCIA promotes and protects the viability of private competition for the benefit of consumers and insurers alike. APCIA represents the broadest cross-section of home, auto, and business insurers of any national trade association. APCIA members are insurers of all sizes, structures, and regions, which protect families, communities, and businesses in the U.S. and across the globe. Bob's responsibilities include oversight of legislative and regulatory policy development and issue identification for personal lines insurance, as well as claims and auto safety issues. He's also APCIA's point person on autonomous vehicle policy. Bob serves as a media spokesperson as well as an insurance expert for APCIA before state and federal policymakers on his portfolio of issues, and is the staff liaison for multiple APCIA member committees that help set association policy direction on personal lines insurance and claim issues. Welcome, Bob. We're so excited to have you on.
I'm glad to be here, Adam.
Awesome. So to get us started, I always like to start with the bio, but can you share an interesting fact about yourself that's not contained in your bio?
Sure. Well, it's kind of insurance is kind of the family business. My father was an insurance broker, so I've sort of grown up around it. Even in high school, I got to do a project in high school where I went to London and spent some time with brokers at Lloyd's of London. So I guess it's like I said, it's a family business, and it's something I've been involved with my entire life.
That's very cool. So it runs in the family, and man, getting to go to Lloyd's of London when you were a kid, that must have been quite an experience.
It was. It was. Well, first of all, I got to go to London. Number two, but it was really fascinating to learn. Actually, I got to learn more about what my father did for a living by following around some brokers at Lloyd. So it was very interesting.
That's very cool. Well, we're super excited to have you on. Today, I was thinking we could start off in the realm of homeowners insurance.
Mhm.
And so one thing that's been top of mind for a lot of people lately, both individuals and in the media, is, with the increasing frequency of extreme weather events each and every single year, it seems like, what would you say is the reasoning behind insurance companies significantly raising homeowners insurance premiums and pulling out of states like Florida and California in particular?
Well, first and foremost, the premiums that we pay for insurance, whether it's auto insurance or homeowners insurance, the primary driver of what we pay is what are the losses. And when the losses are going up, then there's really only one thing that can happen to premiums. And insurers are raising premiums because there's been an increase in losses that's been driven by a number of things: inflation, increases in material and labor costs. Talking about auto, the complexity of the vehicles themselves is making them more costly to repair. More homes and businesses are being built in places that are subject to more extreme weather in coastal areas and in the what's called the urban wildlife or wildland interface, or the places where wildfires typically happen. So you've got a lot of people building in those areas too. So that's one of the things you're going to see. So now we have a situation where insurers are actually, in some cases, paying out more in losses and expenses than they take in premiums, which means premiums have to go up. And that can cause problems because property casualty, first of all, property casualty insurance is very competitive. There's over 3,600 insurers in the United States. All you have to do is watch TV for about 10 minutes, and you're going to see a lot of ads for it, particularly for personal lines insurance products. And there are some states where it's very difficult to increase your prices because of the regulatory process there. California is probably the best example. If you can't raise premiums and you're losing money, then you're going to limit your exposure. So in states where you can reasonably increase your prices to cover what you're paying in losses, that's what's happening around the country. But in places where it's more difficult, or companies might feel that they're overexposed, that's when you see they're going to limit the number of new business they write. They might pull back on the number of agents they have. They might do all kinds of things. And those are the kinds we're seeing out there. And contrary to popular belief, property casualty insurance is not necessarily a highly profitable business. The average return is about 5.7% compared to, for all industries, it averages about 16%. So it's a relatively modest return on capital. And if you've got situations where you're losing money for every dollar of premium you write, that's not sustainable.
Yeah, that makes a lot of sense. And one term that I've actually heard a lot lately is the concept of the insurance desert, which seems to refer to these areas of the country, like you talk about, where insurers have either partially or completely pulled out of. It also sounds like, and from what I've read, insurers are closing offices and significantly decreasing their ad spending to really not just not have offices there, but also to discourage people from obtaining new policies where it's too expensive to provide that insurance. One, situation I think about is my uncle. He actually bought a home a few years ago in Lake Arrowhead, California,
Mm.
and ended up with a very expensive homeowner's policy. But new home buyers in the area are even less lucky because they're not even able in a lot of cases to obtain any homeowner policy because most of the insurers have pulled out of Lake Arrowhead due to that higher risk of wildfires in those recent years.
Or they already write some business there as it is. And that's one thing is you don't want to be, as a company, you don't want to be overexposed in any particular area. So you might limit your writings in some different areas. But like I said, it's all a matter of, if you can't get sufficient rate approved to be able to cover your losses and expenses with any kind of return, then you're going to limit your exposure to that. You're going to try to avoid losing money.
Yep, that makes a lot of sense. I think a lot of people forget that insurance is also a business. It's trying to provide a good service to the public and to people, but it's also a business at the end of the day, and they are trying to make money. So, with that being said, what should homeowners do if they either can't afford the skyrocketing premiums that you're talking about, or if there are no more insurers willing to cover their area?
Well, first and foremost, wherever you live, whether it's a place that's where it's tough to find insurers willing to write or not, shopping around is always the best thing to do, and do that every couple of years. That's always the advice I give to anyone, and when I talk to the media or anyone else about these kind of issues. But and things like if you find that the premium is higher than you expected, there's other talk to the agent or talk to whoever you're dealing with about there could be some things you could consider higher deductibles, or things like that. If you can't find an insurer in what would be considered the voluntary market, that most states have what's called a FAIR plan, which is sort of an insurer a state-run insurer of last resort. The rates are going to, it's not going to be any less expensive than it would be. It actually would probably be more expensive than it might be on the voluntary market, but those are available. There's also something called the surplus or excess lines market, which are insurers that they write all kinds of business, but they're not admitted insurers in the state. That is, they're not regulated by the states. They are permitted to do business, but usually to be able to access the excess and surplus lines market, you have to have so many rejections from companies, and then you can get that. That's an option for if you're talking about somebody like it might be a high net worth individual. You got very expensive properties. You want to find a place to insure that. A lot of people have had to go to the excess and surplus lines market for coverage. Again, not a cheaper option by any means, but that's available, as long as you meet the requirements, and you have to go to an agent who has that kind of a license to be able to place business in the excess or surplus lines market.
That makes a lot of sense. Yeah, I've heard also this dichotomy between what are called state-sponsored plans versus the insurers of last resort.
Yeah.
You mentioned the last resort, but can you talk a little bit about the difference between those two types of coverage options?
Well, I talked about fair plans. That's like a state-run insurer of last resort. Basically those are, people go and get their insurance through those plans, and the costs of those are sort of spread across all insurers. Companies are assessed for those policies, for the losses that are there, and basically that loss gets spread amongst all policyholders too. because those assessments come from the premiums that we all pay at some point. The surplus lines is different. Those are private companies that they write business, and that serves a function of not only for providing coverage where there's not coverage available in the admitted market, or as we call it, but also that's also where, like, new businesses that don't have any kind of track record typically find their coverage too. A good example is when we started, like Uber and Lyft, the transportation network companies first started. Well, there was no track record for private individuals driving others around in their vehicles. So Uber and Lyft went to the surplus lines market to get coverage for that. And after a while, that risk became better defined and more well known, and now they're written typically by companies that are in the admitted market. So that's the other function that the surplus lines markets serve.
That makes a lot of sense. Yeah, I had no idea, because I mean, that makes a lot of sense. Like Uber and Lyft, it was a very new, very novel type of insurance that was required. So they had to go these private companies that innovated new ways to provide insurance for those types of policy owners. Another kind of extreme event that I also think about getting coverage for is flooding, which is very, very common here in my hometown of Houston. How would you say Houstonians should think about insuring themselves against these extreme flooding events?
Well, after Hurricane Harvey, the estimate was that as many as 80% of those flooded didn't have flood insurance. It is available through a federal program called the National Flood Insurance Program. And there's a new program called Risk Rating 2.0 that may provide options for lower cost coverage. So that's the first thing that you should think about if in any area susceptible to flood, is look into flood insurance. Even in areas that aren't traditionally susceptible to flood, you never know when that 100-year flood or 150-year flood or whatever, when that happens. So it's always wise to look into that. There's also private insurance companies that write flood in the Houston area. So again, it pays to shop around. Finally, think about the fact that 1 inch of water can cause about $25,000 damage. And that's according to FEMA. It really doesn't take much to do a lot of damage to your home. The other thing in Houston is to make sure that runoff drains in the street are clear from debris. That'll help give water a place to go. Like if you know that there's a big rainstorm coming. Actually, I live outside of Chicago, and we have a storm drain right out in front of our house. And one of the things that we do in storms is go out there and make sure all the leaves and things that collect over it, aren't clogging it up, so it doesn't start to, flood our front yard or something like that. So those are good things to be aware of too.
That makes a lot of sense. Because that was going to be one of my follow-up questions, is specifically when it comes to homeowners insurance, what role does the government play in helping to mitigate not just extreme flooding events, but also other types of extreme weather events or events that are considered catastrophes from an insurance perspective? And it sounds like some of the major ones are just things that we probably take for granted, but drainage that is proper and adequate, roads. Are there any other things that governments have to specifically be aware of and get in front of when it comes to making property casualty insurance the best possible for policy owners?
Well, there's all kind of things. APCIA has supported all kinds of mitigation efforts, and some of it starts with, there are rules about land use and things like that. About when you build a new subdivision, you have to have proper drainage for it. And that's why in newer subdivisions, you usually see some sort of retention basin or something like that, just for those kinds of situations. And those are roles of government and developers and I guess all of society, to make sure that we're planning appropriately, to make sure that to try to mitigate these risks. That as climate change has its effects, and these events seem to be happening more and more often, we have to think about those things, and even around your home, simple things like making sure that your grading is pitched away from your home, so you're not letting water pool up around the foundation of your home and seeping into your foundation, which underpins your entire home. All those kinds of things are things to think about.
That's really fascinating, and it's really drives home the point of we all have a role to play in this entire ecosystem of insurance.
Yeah.
We're stakeholders, and the government and the insurance companies are too. Another issue that I think doesn't really come to mind as intuitively when we're talking about homeowners insurance is crime, but it certainly is an issue that many Americans have been concerned about these days, especially in the past couple of years since COVID. Has this widespread sentiment and concern about crime entered the dialogue amongst insurers? And if so, how?
Somewhat. What I hear most often from our members is on the auto side, and that's vehicle and catalytic converter thefts, both of which have kind of skyrocketed in recent years. The vehicle thefts have been largely driven by the vulnerabilities in some Kias and Hyundais, which you might have seen. There was a social media phenomenon, whatever you want to call it, where that sort of started in the upper Midwest and spread to places like Colorado, and I think Missouri is or might be the capital for it now, but it's happened all over the country. Catalytic converter thefts, that really started to boom during COVID, where you had a lot of vehicles just sitting and not being used very much, so they were easy targets for thieves who are after the precious, the metals that are inside it that were worth a lot of money. Actually, the price of those kind of things like rhodium and some other things had skyrocketed for a while. That's come down, and we've seen thefts come down a little bit too with that price, but those are big concerns. Retail theft is also up. We haven't heard of that impacting the markets for commercial insurance, though, either. But obviously, that's a something that insurers watch closely.
Yeah, no, that I think that's a key point. Actually, talking about catalytic converter theft, one of my good friends got a brand new Toyota Tacoma truck right after COVID, and that's, at least here in Houston, that's, I think, was one of the peaks of those thefts. And he was super worried. I mean, we went to eat at a Chinese restaurant, and I mean, he was, checking out of the window of the restaurant every 5 seconds, even though we were only in there like 45 minutes to an hour. We weren't in there that long, but it was something where you didn't have to leave your vehicle overnight for that to get stolen. So I certainly understand that. And then, whenever you talk about retail thefts, especially as a CPA, I have a personal affinity for the term shrinkage, which the Wall Street Journal actually reported on the other day. You're seeing these videos posted all across social media and the internet of really these mobs of people just going to malls all around the country and just stealing things en masse. And that's becoming an increasingly large issue for inventory and the inventory shrinkage on companies' balance sheets. And so a similar story holds true for individuals as well. I also want to revisit this point where you talk about, additional considerations for people that may have more wealth or higher net worth. What additional considerations should those folks consider when choosing an appropriate homeowners policy?
Number one, make sure you accurately value your property. It's not worth any savings you might get on your premiums if you find yourself underinsured. Work with your agent, work with your company to make sure your limits reflect what it actually would cost to rebuild your home or to replace your property in the event of a loss. If you have jewelry or artwork, things like that, those can be added to policies via special riders. You usually have to get them appraised and things like that, but it makes sense to do those things, not only because you want to make sure they're valued properly and insured properly, but if you add riders, like for jewelry, you usually get a little bit broader coverage too. So like just for the average person, if you've got your wife's got an engagement ring, if the stone falls out and you've got it added to your policy on a endorsement or rider, that can be covered. If usually just your regular homeowners policy will have coverage for jewelry, but it's limited to like maybe it's limited to a couple $1,000s and only for certain perils, not for just the stone falling out someplace. So those are the kind of things to definitely think about. Also for high net worth people, the more you have to lose in a liability situation. For example, if you cause a serious auto accident, but you decide to go out and buy a minimum limits policy, your assets are going to be vulnerable, and the courts will not look favorably on you if you're driving a very expensive car with minimum limits. You want to make sure that you get enough liability insurance to be able to cover your exposures and protect the things that you worked hard for.
100%. And one of the things I always try to drive home with my clients is an umbrella policy, which of course provides that liability coverage over and above your underlying homeowners and auto policies. And so especially in cases where, you have a young teenage driver in the house, or you have a pool, or if you're just particularly worried about, your assets, if you were to get into an accident and seriously hurt someone, an umbrella policy probably makes a lot of sense for you. But kind of on that similar topic, does estate planning ever come up in the conversation about homeowners and property casualty insurance? And, whenever you talk with either insurance companies or with regulators or policy owners?
Not as much in property and casualty, but I think the important thing would be making sure the right people, like whoever's your executor, if you have an estate plan, whoever's your executor, or making that a part of the information that you gather together for the executor or for a trust or whatever, making sure that they have the right information, who your homeowners insurance are, who your auto insurer is, all those kind of things. So if you're going to put someone in charge of your estate when you're gone, they should know all that stuff, who your agent is and things like that too, because and particularly if like someone's going to inherit your home, you want to make sure that the premiums are going to get paid and things like that while while your estate is being sorted out and things like that. So I think that's where that comes in, is number one, making sure your assets and your liabilities are insured, but also making sure that that kind of information is part of what you pass on to heirs.
For sure. And I think that that's an excellent point. Especially here at our firm, we always talk about the concept of a red folder. And so have all of those documents in there that you'd want your loved ones to be able to just have in one easy to access place once you're gone. So that includes, like you mentioned, the information regarding your insurance policies and, who your CPA is, who your estate planning attorney is, close family members, close friends that know about your assets, that know about the situation. Obviously contact information for all of your loved ones. Those are all important things to have in your red folder. And insurance, I think, is one that I'm certainly going to recommend that clients start to add, because I think that that's a great point. Yes. And then also when it comes to, estate planning, especially, going back to higher net worth individuals, a lot of wealthier clients have an inheritance goal of a certain amount of assets to leave to their kids. So having those robust property casualty policies in place while they're alive can help to make sure that their assets are protected so that they can pass them on to their heirs when they're gone. So I think that that's an excellent point. And it also goes back, for me as an advisor, what is the role of property casualty insurance in the context of their broader financial plan? The metaphor I like to think about personally is it's a kind of financial seatbelt for your life journey. And just like a regular seatbelt, talking about auto insurance, especially, you hope to never need it, but it's there to provide that crucial protection when the unexpected twists and turns of life come your way, helping to ensure a smoother journey through the ups and downs of your life.
Exactly.
So that makes a lot of sense. I also want to circle back to something you mentioned earlier. You touched on a little bit, which is inflation. Excuse me. So there's been hugely spiking inflation in the past couple of years, especially since COVID happened, either from the demand side of the equation or the supply side. How would you say that both inflation and higher interest rates have affected property casualty insurance in the past few years?
Interest rates is more of something that affects life insurers and the way that they invest, because their tail on when they pay claims is much longer. Their horizon on when they pay claims is much longer. Not so much for auto and home insurers, but the inflation has had a significant impact on property casualty insurers because of it's impacted the cost of everything that those products pay for. From all the materials that are used to rebuild homes after they're damaged and vehicles and the labor that goes into that. So that has had a huge impact. And like I said before, that's really driving a lot of the increases in home and auto insurance that we're seeing around the country. And another thing to keep in mind is that some of these, inflation is starting to go or ease. It's increasing at a decreasing rate now, something closer to what we've seen in the past. However, a lot of those things that have increased, like for example, body shops have had to pay higher salaries to their employees to be able to get people to do the kind of work. And because the cars have become so much more technologically sophisticated, they need more expensive training, which usually leads to having to pay people more that have that kind of training. That isn't going away. Those costs are probably not coming back down. We might see some decreases in the cost of things like some raw materials like wood and things like that. But the cost of labor associated with that, the people that are skilled enough to do the kind of work that's necessary, that's unlikely to come down. On the auto side again, cars are only getting more sophisticated. There are increasingly more the vehicles are more connected and also have more features that help keep us out of accidents. But unfortunately, when we do, those things like automatic emergency braking and the cameras and the sensors and the systems that are in today's cars, they're more expensive to repair. So all those things are likely to stick around with us for the long term.
That's really an intriguing point because something I've heard, just talking to mechanics in general when I go to get my car repaired, is that with these more technologically advanced cars like a Tesla, for example, there are fewer parts. So if you know what you're doing and the parts are not on backlog, which for the past few years they pretty much have always been on backlog, then in that case it's going to be easier to fix. But like you mentioned, it's kind of a counterintuitive point because it's maybe easier because it has less parts, but you have to be more highly trained because it's more technologically advanced. And also the workers have to be paid more because even though there are fewer parts in a Tesla than there are, let's say, in like a Ford F-150 or something, even though it's a much bigger vehicle, you have to be more highly trained to repair a car with more software than hardware like a Tesla.
Yeah.
So that makes sense. But going back to the whole conversation about inflation, I think that's also something that's lost on a lot of people is, and tell me if you agree or not, but I think of inflation as like acceleration, like you think of in physics, it's the rate of change, right?
Yes.
So it's very counterintuitive because the economy is actually pretty strong right now, all things held equal. Unemployment rate is at historical lows. Wages have gone up significantly, even if at a inflation adjusted basis, it hasn't as much. But the sticker shock from seeing the prices much higher from the inflated prices themselves is not enough to outweigh the fact that the inflation, the rate of change is decreasing because the overall sticker price has increased so much over the past couple of years.
Yeah. And people often don't understand that, that just because the inflation rate is lower doesn't mean prices are going down. It means they're going up at a slower rate. The natural trend economically is that prices increase over time. And inflation is measuring, you're right, the rate of change.
That's an excellent point, Bob. Now, we've been, talking about this concept of auto insurance, and so I want to segue to auto insurance for a moment here. But something that it seems like consistently keeps coming up, both statistically in the research that I've read, but also anecdotally, just seeing, so many more accidents on the road. People during COVID, are frustrated. They want to get out and travel. Would you say that American drivers have become worse over time overall? And if so, how has this affected auto insurance?
Yeah, well, since the pandemic, it seems like everyone you talk to has a story about something crazy they saw another driver do. And now we're seeing some studies, like you said, to back that up. AAA, the American Automobile Association, did a driver survey that showed an increase in unsafe behaviors that people admitted to doing. Things like speeding, aggressive driving, impaired driving, both from alcohol and from marijuana, using devices while driving, and even running red lights. People admitted that they had done that more. And there's a company called Cambridge Mobile Telematics that provides the usage-based insurance software that's on, like if you buy like Progressive Snapshot or something similar to that. They're called telematics or usage-based insurance programs. that it tracks how you drive and helps. That helps set how your prices or your premium is set. Usually you get a discount to sign up, and then you can earn a bigger discount depending on how you drive. And it also gives you feedback in real time. But that's Cambridge Mobile Telematics is probably the biggest vendor of those kind of programs, and their database shows that there's been a 23% increase in interacting with devices while driving. That's up to 58% of trips that they measured had somebody messing with their phone. And their programs are also able to detect crashes, and the incidence of the likelihood of a crash increases by 240% if you interact with your device during a trip. So there's something that everybody can do, and that's just I guess it's an example of how driving habits have deteriorated. People tend to think of the vehicle as an extension of their living room, and it's not. You have to pay attention at all times. And these stories that you hear, they're all true. We've all seen them, but we all can play a role in stopping that by changing our own behaviors.
That makes a lot of sense. Yeah, I've heard and read about this, new way of sort of regulating the insurance, premiums, and also how to manage drivers and see if they're actually doing what they say that they're doing when they say that they're improving their driving over time. So can you talk a little bit more about what telematics is exactly, how it works, and is it actually, accomplishing what it's set out to do, or in some cases are policy owners paying higher premiums even if they end up being good drivers?
Well, in most cases, you get a discount just for signing up, and most companies operate on that basis. Although there are some that you can go up, and you can go down, and you can go up depending on how you drive. But mostly these programs, for the most part, they're either a device you can plug into what's called the onboard diagnostic port of your car, or more common now is a smartphone app that is able to tell when you're driving and when you're not, just like your phone is able to tell. And it will track things like, how fast you're going, what time of day you're driving, how much you drive, how many, rapid, hard stops you make, and how many times you interact with your phone. And that'll sort of develop a score for you along those lines. And with that, you either earn a higher discount or a higher premium, depending on the program. Every insurance program is going to be a little different, but the real benefit, one of the big benefits of a program like that, is that you get real-time feedback on how you're driving. I've been using one of these programs for a number of years now, and one of the things, I never realized how much that I exceeded the speed limit. I never realized how much that I roared up to a stop sign and braked hard. But I've been able to track my own driving and been able to improve both of those areas. Actually, in my house, we have 3 drivers, and we're able to I'm able to look at everybody's score. We're able to look at each other's scores and sort of compete with each other on those lines too. So you really can improve your driving and improve your, how it's an opportunity to not only drive better, but to maybe save yourself a little bit more money on your insurance. So, and especially now with people are always reluctant to be tracked. That's why telematics has always been sort of the next big thing that people predicted. It's going to boom anytime. It's very popular in Europe, but it's never really caught on here because people don't like the idea of being tracked while they're driving. But there's only very limited information that's being tracked, and you get to see what's being tracked, and you get that feedback in real time. You can open up your app and you can see trip by trip how you did, and you can change your behaviors accordingly. So I recommend it. My own personal experience has been great. I recommend it highly. It's something good to explore, and I think people have been more, especially since people are a lot of people are driving less, especially those of us who are lucky enough to be able to work from home, or have a hybrid approach of things like that. So you're not doing as much point commuting. It makes a lot of sense to look into that. It makes a lot of sense to look into those kinds of programs.
Man, that sounds like really, quite an advancement. And Bob, I'm not sure if you have kids in the house that drive, but if you do, it's probably fun to give them a hard time about their driving statistics. Is that something that comes up
Well, you can also get a hard time from them as well. So
That's true. I didn't think about the
it
double-edged
cuts both ways. So
sword.
yeah, but particularly if you've got young drivers, if you've got a brand new driver, it's a great tool. Number one, to give your young driver some feedback about how they're doing and things like that. And usually it cuts both ways too, that they can see how you do too, which is part of setting a good example for your kids. So.
Like, hey, Johnny, no pulling out, ripping out of the Chick-fil-A parking lot, but at the same time, hey, Dad, stop roaring up to the stop sign. So I definitely understand how that could go both ways. But with these more innovative and dynamic pricing structures, one of the ones I've read about and the fastest growing ones has been risk-based pricing and credit-based insurance scores, or CBIS. So how do these new pricing methods work, and how have they changed the insurance landscape?
Well, it's really not so new. The basic premise of insurance is pooling risk and then tying each insurance premium to the risk that they present. Risk-based pricing does that by looking at a variety of factors that are all correlated with risks, or in this case, the likelihood and the cost of claims. It used to be that there were, like for auto insurance, there was only two kind of risks. There was good ones with no claims and no tickets, and bad ones with claims and tickets. And if you were a good risk, getting insurance was easy. If you weren't, you might have to go into a residual market or a assigned risk pool where the premiums were much higher, just like we talked about in homeowners. And at one point, there were huge numbers of people in those assigned risk pools in the States. When credit-based insurance scores came into use, and this is back in the mid 90s, it became much easier to assess risk and to do so more accurately. No longer were risks just good or bad. Any risk could be good as long as it was accurately priced. And with that ability, insurers could compete for business for the best drivers and for drivers that are not so good. And that benefited all those kinds of drivers. And those assigned risk pools rapidly depopulated. The total volume of cars in 1985, there was almost 1.6 million drivers in those pools across the country. By 2023, there's 190,000. So those pools are shrunk to virtually nothing because of, and credit-based insurance was only the start. There's other, most companies use what's called multivariate rating, and they have what could be, 10 or 15 different rating factors that they use. And the benefit of that is that even if one of those things doesn't treat you very well, you have other things that can make up for it. So like I said, even if you've got a ticket, you can still have some insurers that will compete for your business, and there's other rating factors that might counterbalance the fact that you had that one ticket or an accident a couple of years ago or whatever that may be. So, risk-based pricing has always been the foundation of insurance, but the things like credit-based insurance scoring and multivariate rating is really what's helped to make auto insurance more affordable and available across the country.
That's a really fascinating point. So it sounds like credit-based insurance scores are sort of like a credit score, but for your insurance policies specifically.
They use a credit. They use elements from that are in your credit score that are only predictive of accidents and claims. Not every element of your credit-based insurance score is going to be predictive of. And insurers don't use anything as a rating factor unless it accurately predicts, losses. There's no reason for them to do it otherwise. The whole point of the exercise is to try to tie premium to risk.
That makes a lot of sense. So the credit-based insurance scores, they're using more accurate data, more relevant data, and also introducing more nuance to the insurance pricing calculus. And that's sounds like it's creating better outcomes for policy owners, which obviously is a win-win for everybody.
Well, another thing, this is where shopping around is a benefit too. Every company has their own, secret sauce, if you will, the combination of factors and how they weight them and things like that. So you might find, if you shop around with 5 companies, you might find that company 1 has a better price for you than company 5, or you might have been with company 3 for 20 years. And you might find that one of those other companies has a better rate for you, or you might even be able to take that and go back to your current company and see what they can do for you if they want to keep your business. And that kind of stuff that works in almost anything you shop for. If you're shopping for a car or you're shopping for auto insurance, it always pays. You spend you spend an hour shopping around, and you probably can, never do you probably can, if you save a couple $100, then that was an hour well spent.
That's beautiful. I love that. Shopping around for policies, nothing better. And sounds like CBIS scores are just the thing to help facilitate that.
Yeah.
So that's really on the, consumer policy owner side. But, again, looking at laws and the government's role, are auto safety laws better or worse now than they've been in the past from a auto insurance perspective?
Well, I think safety laws, with few exceptions, they're better. We've made improvements in distracted driving laws and impaired driving laws. You know, there's most states, the majority of states now, prohibit things like texting while driving or using a device, holding a device in your hand while driving and things like that. On the other hand, we've had lots of states raising their speed limits over the years. And there's an organization that the insurance industry funds called the Insurance Institute for Highway Safety. You've probably heard of them. They're the ones that do the crash tests and things like that. Those are lots of fun, but they also do a lot of research into safety, traffic safety laws and their effectiveness and things like that. And one of the things they found out that from when the national speed limit of 55 was repealed back in 1983 through 2017, the increases in speed limits resulted in about 37,000 more fatalities than it had those national speed limit remained in place. And right now we're having, more than, we're killing about 40,000 people a year on our roads, which is higher than we've ever been. And that's been, largely, the number of fatalities had gone down for decades until basically the last few years. Coincidentally, that's part of the time that the smartphone found its way into vehicles as well. That's not the only reason, but it's certainly a contributing factor. But so those things, having the right laws in place is only part of the equation. They have to be enforced too. And even things like speed limits, they have to make good decisions about when you set those things and when you increase those things. So I think overall, I would still say that they're better. Speed limits is probably an exception.
Yeah, I mean that's also a really fascinating point because if you look at videos from, let's say, the 1970s, whenever seatbelts really started becoming a lot more widespread in the United States, there are videos of people that were like, man, what are these seatbelt things? This is kind of an inconvenience. They're very uncomfortable for me. And it was kind of this avant-garde revolution, right? But I'm curious, whenever we look back 50 to 100 years from now, how is history going to view the repealing of the 55 mile per hour speed limit nationwide in the 1980s, like you talked about, that resulted in 37,000 more fatalities? If you go out, I know it's going to be different in Chicago. I'm sure in rural Illinois it might be similar, but if you go out to West Texas, I mean, the speed limits can get up to 75. I think I even remember seeing them at 85 out there, like way out in the rural areas, like where there's not a city for hundreds of miles. So that makes a lot of sense. The other trend that I wanted to ask you about was there's been this increasing of pedestrian deaths steadily over time on U.S. roads. Why is that, and how is that affecting auto insurance?
Well, again, it goes back to anything that increases losses is going to have an impact. So when you're having more pedestrian deaths, that usually means a much more expensive insurance claim is attached to that. But as for why this is happening, there's more people walking and biking than ever before, which is great. But in many cases, we've built roads that aren't really designed for that, especially in suburban areas. And I bet you Houston is like this too. They had a lot of growth over the years, and there's a lot of places that don't have sidewalks, or you've got major arterial roads that aren't highways, but they look like highways. But there's no crossings, there's no bike lanes, there's no place for those pedestrians or those cyclists to be, and that brings them in contact with more traffic. And when that happens, unfortunately, that means what we're seeing is exactly the result. And you couple that with a deterioration in driving behavior, speeding, red lights, all that kind of stuff. That's what you get. And the design of vehicles has also come into play too. There's a lot bigger cars out there now. SUVs are with very flat fronts are in place. IHS has done some studies about this too. I mean, when you have a car like a sedan that has a sort of a tapered hood, you hit a bicyclist, you hit a pedestrian, they can kind of slide up over the hood. But when you hit a vehicle that has a blunt front end, there's nowhere to go, and the damage is usually much worse. And bigger, heavier vehicles do more damage, whether it's to other vehicles or people.
Man, yeah, I never thought about that, but that makes a lot of sense. And there's always been a part of me that felt like it was wrong. Like if you see those, just like a normal school bus, but that have the very flat fronts, and it's like, just a huge school bus. It kind of reminds me of the smaller SUVs that have the same thing. And it doesn't, number one, it doesn't look aesthetically pleasing to me, but it also is extremely dangerous. Like you said, because, not not just from the fact that it's not aerodynamic and you're probably getting much worse gas mileage, but also from the fact that if you hit someone, it's probably going to be a much worse outcome. So I think that's an excellent point. Whenever you look at rankings of, cities by their mileage of, walking, biking lanes on the roads, Houston comes in right near the top of the least per capita. And so, having city initiatives, having statewide initiatives to help to implement more walking, biking lanes for people on the roads, I think will help that. There are certain parts of Houston, like the Heights, that have more biking lanes than others. But certainly it's something that should definitely be more widespread.
Mm-hmm. Yeah.
So, another thing I want to think about is, we talked a little bit before about cars like Teslas that are increasingly connected to the internet. That's also given rise to cybersecurity concerns, because anything that has internet access can be hacked, and can be taken over by a bad actor. How is that reshaping auto insurance?
I think that's something that insurers think about, but I think the biggest change for auto insurers is not just the vehicle, the connected vehicle, but those systems that increasingly assist or take on parts of the driving task. I think I touched on this before. If you're using adaptive cruise control, or what Tesla calls autopilot, or full self-driving, an insurer would need to be able to, if there's an accident, an insurer would be able to need to be able to know whether that was engaged or not at the time of an accident, and be able to get access to that data. I've been in the industry a long time. I started as a claims adjuster, and it really is pretty straightforward to investigate an auto accident. You talk to the driver, so you get a version of what happens. Usually, the damage to the vehicles would tell you a lot, but if you've got the vehicle itself taking on a large part of that role, the only way to tell what really happened is to be able to get access to the information that the vehicle has gathered about what was being used at the time of the accident, when was there braking, and things like that. So that's something that we've been working on, is making sure that vehicle owners had access to that kind of information that they can in turn share with their insurers, if there's an accident or something like that. Connected vehicles can also help facilitate the usage-based insurance programs that we talked about earlier. A lot of them are able to transmit data directly to car insurers or to clearinghouses. I own an Acura, and that's one of the things that they tout, is that, hey, we can share data from your vehicle with insurers if you want to. I already use another system, so I don't take them up on that, but that's something that's available out there too. As for the hacking, I mean, obviously we insure these vehicles. We don't want to see them hacked. We think there's a way to balance the need for access for insurers for this kind of data, and make sure they're still secure, that somebody can't get into them and make them do other things. But I think there's only been a couple of examples where that's actually happened so far. And that was a sort of a white hat hacker had gotten into a vehicle, was able to hack into a vehicle. But we haven't seen that happen. But I think that's something that our manufacturers are certainly concerned about, and insurers as well.
Yeah, for sure. And, of course, something top of mind for a lot of people these days is just broader data concerns about their personal data. And oftentimes they don't want that being shared. And so it sounds like with something that's increasingly connected to the internet, the manufacturer and whoever else will have probably real-time access to data that the person may not even have a chance or the knowledge to opt out of. Is that a consideration? Am I thinking about that in the right way?
Yeah, when you buy a car nowadays, there's a lot of agreements and things you're signing. It's almost like when you have a real estate closing and all the papers you have to sign. There's almost as many papers for buying a new car, and sometimes you're signing some kind of a terms of use, like those things that you get from apps on your phone and things like that. You'll probably get something like that for your car too. It pays to pay attention to those things and make sure that you know exactly what information is being shared with your manufacturer and what they're doing with it and how they're protecting it. That's all usually laid out in those kinds of terms of use documents. But it's important to know what you're signing and what it entails. So yeah, unfortunately, you got to read the paperwork.
Always read the fine print.
Always
Always
read
read
the
the fine print. Right, even if it's not the most fun thing in the world. So with these cyber threats that are becoming increasingly common,
Mm.
the new one of the new buzzwords, especially since COVID, has been NFTs and very valuable digital assets. How is the insurance industry adapting to provide coverage for the digital landscape and these new kinds of assets like NFTs?
Well, I'll kind of tackle this two ways. The cyber insurance market is rapidly growing, and the risks are even more rapidly evolving. We recently released a white paper showing that the market for cyber insurance is stabilizing, like for companies that have the risk of somebody hacking into their data or something like that. And that market seems to be stabilizing, and our requirements have greatly improved businesses' cybersecurity. As for things like NFTs, my understanding is that there isn't coverage widely available, primarily because they're so difficult to value. And insurers crave certainty. They want to know. It's all about risk. It's all about assessing risk, and they want to know what risk they're taking on. The NFT market is growing, and insurers like to write insurance. So as it continues to grow, somebody's going to figure out how to take on that risk. But for right now, I don't think there's a lot out there, from what I've been able to tell.
Yeah, that makes a lot of sense to me. I don't think anyone is going to feel sorry for someone that bought a Bored Ape NFT artwork on the internet during COVID for $5 million and then it went to zero. I would say maybe the only person that could help you is Lloyd's of London, but I don't even think they would touch something like that. So
From what when you asked that question, I did a little checking around, and there's not a lot out there. And again, primarily it's because it's hard to value what you're taking on, and because the prices can be so volatile, like you said, and that's true of cryptocurrency as well. It can be very volatile, go up and down really fast. So NFT is sort of the similar concept. So you have the same kind of volatility.
that makes a lot of sense to me. So, speaking of all of these new trends that started during the COVID pandemic, how did the pandemic itself change, how you think about P&C insurance and the landscape, both for insurers and for policy owners?
Well, I think it changed some of it changed some of the risks that we insure, like changes in traffic patterns, more remote work, less commuting, things like that. Change the way that people are driving, so that changes the nature of the risk. Insurers have, particularly during COVID, when they couldn't go and they didn't want to send their employees out and things like that. Insurers use a lot more, like for claims handling, they use more virtual inspection tools. You can actually, most companies have some kind of a tool where if you get in a minor fender bender, you can use your smartphone to and someone can guide you through the process of, inspecting your vehicle and getting an estimate sort of on the spot, and things like that. The same thing is true of, smaller homeowners losses too. We've also seen a change in like homeowners risks. Remote work enables people to move far away from, they used to have to go to an office every day and now they don't. So they move somewhere much further. It could be someplace further away from congested high cost areas, which might mean savings for them on insurance, or, definitely a change in what you're in the nature of the risk you're insuring. But it also could mean you're moving into into a forest someplace, which is probably beautiful, but maybe the risk of wildfire is much more increased, or you move to the beach or to a coastal area and things like that. So I think those are the kind of things that changed there. And then, all the other things that came out of it's, from some of the supply chain issues we still see from time to time, and things like that have all had impacts on insurance.
Yeah, that makes a lot of sense. And those are, some of the common themes that, I see and I hear about as well. Also for, our clients that are small business owners, I'm curious what you've been seeing in terms of the new trends in business continuity insurance since the pandemic. Has that side of the equation changed at all?
Well, one of the big debates early in the most business interruption policies and things like that had exclusions for communicable diseases, and for a good reason, is because it's one thing to have to be insuring a business against a hurricane, which is going to strike. It's going to strike a lot of businesses, but in a confined area. But a pandemic is different. It strikes everyone, everywhere. And it's really not an insurable risk, so that hasn't really changed. It was something that was excluded before the pandemic, and it's still excluded today. So I don't know that that's really changed that much in the nature of what the products were, but that certainly made a role for, government took on a role in that situation for a lot of things there, and that's a whole different discussion. But I don't know how much it really changed in the nature of business insurance.
Yeah, no, that makes a lot of sense. One thing in particular I saw was the CEO of the APCIA, went on TV at the height of the pandemic, and they asked him pretty pointed questions about how come pandemics are not an insurable risk. But as unfortunate as it is, it makes sense because it's such a unknown factor, and it's such a widespread risk that it would pretty much, I mean, bankrupt every insurer if they insured it. Is that right?
That was exactly the calculation, that with the amount of the losses, they were equal to like the total property and casualty insurance industry premium for the past, I don't know, 30 years or something like that. It just would have bankrupted the, if courts had been overturning policy language, it would have bankrupted the industry.
Man, that's wild. That's absolutely wild. The last sort of topic I want to talk about is legal issues. And I know that that's a huge policy area that's important for the APCIA. So what are the foremost legal system issues that insurance policy owners should be aware of these days?
Well, legal system abuse by the plaintiff's bar has been pervasive and persistent problem for a long time. And the practices are wide ranging. It impacts not only insurance affordability and availability at state level, but it generates costs for businesses that are targeted, or any individual who's targeted. The time you have to take to help us aid in your defense, or aid in your defense, and things like that. It started with the growth in the plaintiff bar's advertising couple decades ago, and that sort of created a platform for the plaintiff's bar to further the narrative that businesses and corporations, including insurers and the rich, were bad actors, and that attorneys were the saviors to be able to help them navigate the court system. And it really becomes almost a self-perpetuating, give us a call, you get in a wreck, get a check. Or the billboards in Houston, I know, like in a lot of places, the billboards are everywhere, and things like that. And that's the way that things go right now. And there's all kinds of sub issues within that, but without a doubt, that's one of that's probably the biggest issue that impacts the property casualty insurers, and by extension, everybody who pays for property casualty insurance.
Yeah, no, that certainly makes a lot of sense. And, especially whenever the person that's helping the policy owner works in an industry where they're incentivized to get the largest payouts, to be, kind of these pit bull lawyers, as people talk about, to go for the most aggressive settlements, then the interests of the insurance companies and the policy owners and the lawyers are not aligned, and it's ultimately creating a bad outcome for probably all stakeholders. So I think you answered my next question, which was going to be, why have those awards and costs gone up over time? But how would you say policy owners can mitigate those risks?
Well, you're right. I mean, all those things have contributed to the increasing likelihood that juries are going to award damages are out of proportion to the injury or damage suffered. That's sometimes called social inflation, and that's part of the whole thing that we were talking about earlier. As for how to mitigate that, I think the way to mitigate your risk there is to focus on the underlying risk, i.e., to stay out, to try to avoid those situations. Once you've been sued or once you're in, it's kind of too late to have much impact other than participating in your defense. But that's why focusing on mitigation and prevention and just good basic risk management is probably what's most important.
That makes a lot of sense. And maybe even too, having a good umbrella policy in place could help mitigate some of those risks as well.
Yeah. To what I said, but bringing back what I said before, the more you have to lose in a liability situation. Umbrellas insurance provides, in some cases, usually broader coverage than what the underlying policies do. It sits on top of your homeowners or your auto policy, but sometimes they provide some additional coverage too, and they aren't particularly expensive. So they're definitely worth looking into for any policyholder, because all you have to do is run into somebody's Lamborghini and you might have a problem. So that's a good way to cover those kinds of exposures. And you talked about, I think you mentioned young drivers. I know when my oldest son got his driver's license, my premiums went up, of course, on my auto policy, but they also went up on my umbrella policy, because that had an impact there as well, because the risk had increased a little bit that something particularly bad could happen. But that's also a way of sort of spreading that cost over a couple different policies if you have an umbrella.
Absolutely. No, that makes a lot of sense. But of course, even though the cost went up in that, one situation, umbrella policies comparatively to other types of insurance are pretty cheap, just a few $100s a year for, millions of dollars of coverage. So it's probably worth it. Would you say so?
I would definitely. I've had one for 30 years. So definitely.
Well, that just answers the question perfectly. Well, Bob, that's really all my questions that I had for you today. Honestly, this has been a really fascinating discussion. Really, really appreciate you taking the time to come on our podcast today, and thank you so much.
That was my pleasure. It's fun for me too.
Thanks, Bob.